This is the Financially Simple Podcast, a show dedicated to destroying the complexities of money for today's small business owner. And now, here's your host, pizza-loving, certified financial planner, Justin Goodbread.
Welcome to Financially Simple. This is a finance show for small business owners about money, how it works in our business and personal lives, and how we can build wealth to be financially independent. I'm your host, Justin Goodbread, and today's topic is centered around home mortgages. I was trying to figure out how to exactly title this, and I'm just going to say it's home mortgages because I have a special guest on the show today. But before I introduce my dear friend, I want to relay something that happened to me not too long ago. So I'm driving down a truck, and a buddy of mine, he asked me a question which kind of like set me back. And he said, "So Justin, what is the one financial decision that impacts people's plans more than any other aspect?" And, that's a pretty in-depth question. The very first answer off my tongue was, well, procrastination. Many times we just delay in making activities happen. He said, no. I don't mean like, the behavior side of finance. I mean, what is that one asset or liability which has the single largest impact for the masses? And now that I've figured out what he was going to, I said, let me think about this. And so we drove down the road a little bit, and I came back and said, I have your answer. He's like, oh, really? What is it? I said, it's the house that we purchase. And he goes, well, what do you mean? So I said, the size house, it impacts transportation. So how far it is from our commute, work, or play. It impacts the insurance. It impacts taxes. It impacts the cost of living. Man, it impacts so much. I said, but most importantly, the mortgage often that people use on a house is a severe wealth drain. And he's like, so you're saying not to buy a house? I said, oh, to the contrary. I said, I personally have a house. Majority of our clients, actually, I think all of our clients own really nice houses. Even though it's a wealth drain, it also is a vital key to building wealth. And as he and I were talking about it, he was asking some questions, and I said, you know what, this would be a great topic for our guest today. So the guest I have on the show today is a dear friend of mine. I've known Dan for some time. So Dan Hall is with Elite Service Mortgage in Knoxville. For years and years and years, we've been working together as a consultant. We've been friends forever. So a little bit about Dan is he's actually a U.S. Air Force veteran. He served our country, and for that, I know all of us are grateful. After his tour, he actually attended Western Kentucky University and graduated with a degree in finance. And just as soon as he finished up his degree, he jumped into the mortgage banker field. Now, Dan has been in the mortgage business for about 21 years and currently works with Elite Service Mortgage in almost all of the lower 48 states. And I say almost because he was telling me some caveats on some compliance things which may not be profitable or may not be beneficial for somebody from Tennessee working with somebody in a different state because of legalities or whatever. Over the years, Dan and I have we've worked on countless mortgages together, and this is my go-to friend. He's also my go-to guy. He helped my parents, and he's helped me personally. If that tells you the credibility I place in his efforts and him as a person. So in addition to being just this awesome rock star mortgage anchor, someone who just can give good sound advice, Dan is also a husband and a father. And I've enjoyed he's watched my family grow, and I've watched his family grow. So, man, I know I probably butchered the introduction, but with that, man, thanks for coming on the Financial Simple podcast today.
Hey, Justin, I really appreciate you having me, and thanks for the kind introduction.
So before we jump into the world of mortgage, you and I were talking off air about your life outside of the professional world with the family. Tell me a little bit about what family life looks like for Dan Hall.
Right now, family life is pretty hectic. Both my boys, I have two boys, 11 and 9, and they are both year-round swimmers. And so what that means for me is probably more often than not, I'm traveling out of town probably twice a month, whether it's North Carolina, South Carolina, Kentucky, Alabama, Georgia, other parts of Tennessee to go to different swim meets. So it's pretty hectic, but it's fast-paced, and I really enjoy it.
How have you been able to control a balance between your kids' heavy swim load and the workload that I know personally firsthand that you carry?
Basically, given what I do in real estate, as you know, never ever stops. So just because I decided to step out of town for the weekend doesn't mean I get the opportunity to be disconnected. So I'll have clients that call me, whether I'm at the swim meet, whether I'm, it's at night on a Saturday, early morning on a Sunday. You give them pretty much open access to, and clients have a really good understanding of, hey, this is when it's important to call somebody after hours. And I do try to make myself available at all times. So because a lot of times people are making those critical decisions on real estate, especially with the market as fast paced as it is right now, at night, on a weekend, that sort of thing. So as far as swimming, the two are independent of each other, but I do have to do a lot of work even when I'm out of town.
So let's jump into the details here. And you and we've talked about this many times. I'm probably be a little stronger in my philosophy than you are, but from a philosophical standpoint, I personally believe, and you know this about me, but I want to lay this out as a groundwork. I personally believe that while we're accumulating assets, you're in the phase that you and I are in and many of our listeners are in, that we should carry a big, long mortgage on an affordable house. Just because I say a big, long mortgage doesn't mean to go out and buy a house that's way outside of our lifestyle. I'm talking about if a $200,000 house is what fits in our budget, we need to get as big of a mortgage on that as possible. What are your thoughts on that?
I totally agree. And you and I have had this direct conversation more than once, and especially when you're helping to counsel a client. And I'm also trying to echo some of your thoughts and some of the rules that you lay out for those guys and for me, because you and I have talked about it as far as maybe what I need to look for. But I know the traditional line of thinking, and if you had asked my dad or my mom, in their minds, they should do everything in their power to pay off your mortgage as soon as possible, basically drain your accounts, drain your assets to just keep knocking down your mortgage. But I don't necessarily think that's the best strategy. I consider it probably like you do, which is it's a financial instrument for investment that can build wealth over time as far as your assets are concerned. In the past, you could get a rate in the 3s or the 4s, and your CFP, such as yourself, is really good and get you, a rate anywhere between 8 and 15. Well, that's a pretty good arbitrage, and that's a good difference in rate. And you can build a lot more wealth that way than you can just trying to pile on your mortgage.
So with that being said, Dan, and obviously that was a mouthful that you and I just went over, and, I've got lots of blog posts. I've actually got a podcast I'm working on explaining why you and I think that way mathematically. But outside of that, if someone's looking to acquire a home at this particular point, you and I know you know better than I do, there are a ton of different selections or different types of mortgages that are available in the marketplace. What are those various types that today's consumer who's going to purchase a house might experience?
Most of the ones that people know about. All right, so you have conventional, which is Fannie Mae or Freddie Mac. Most people hear those terms, not necessarily know what they mean. But anytime you hear the terms Fannie Mae or Freddie Mac, that has to do with conventional lending. Then you have FHA, VA, alphabet soup of acronyms, USDA, and then also THEA. And jumbos, meaning anything that's over, you're financing anything over $453,000. So that gets into a jumbo territory. But most people fall in that conventional range. And specifically, if you're a first-time home buyer, you're probably looking at FHA, USDA, or maybe a 3% down conventional, which those first-time home buyer products outside of FHA typically have an income restriction, meaning you can't make over a certain amount. So those products are designed to help those who might otherwise not be able to afford a home or give them a better opportunity with a lower mortgage insurance.
Let me pause you for a second right here because we just gave a lot of alphabets out there, okay? So let me see if we can break those down. You said the word conventional, and then you started saying things like Freddie and Fannie and Sally and FH and all these different things. I don't expect, and we don't have time today to explain who Freddie Mac is and Fannie Mae and all these. In an ultra simplistic standpoint, what do these FHA and USDA and all these different things really mean?
What that means to them is this. FHA, and most people are concerned with how much do I have to put down when they're looking at these types of programs. FHA, 3.5% down. USDA, you can finance 100%. Conventional, you do have the opportunity to put 3% down. And your decision on what you want to do with each one of these depends on maybe your credit and then maybe your budget situation, because each program will allow one avenue to go further out than another, meaning FHA might allow you to finance a higher amount, with a lower credit score and not penalize you. And conventional will probably give you a better rate with a lower payment. And USDA will allow you to finance the most out of those three, but it's restrictive. It's U.S. Department of Agriculture, so it's restrictive on necessarily where you can live. Right. So you might not be in downtown Knoxville. You're going to be on the outskirts a little bit. They just give you opportunities based on your personal situation, what the best terms to offer are, and that's a good CFP question too.
Yeah. And so what I often say, and you and I have dealt with this firsthand with many, 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 in fact, like I said, even myself and my mother, we dealt with this. And what I found is that the mortgage broker, in your case, you're looking at each of these types of mortgages or the offerings, whether it be through Freddie or Fannie, Sally, whoever else out there. And you're looking at the rates that each of them are offering, the amount that's due, the amount that goes down the note, and any type of little caveats that each of these may have to try to put the customer or the client in the best position to meet their overarching goals. Is that an easy, clear way to say that?
Absolutely.
So like you and I, just one caveat, you and I on my particular mortgage, we were going to use, I think it was Sally Mae as the underwriter. And because of our road agreement, we live on a gravel road 1.5 miles from nowhere, in the middle of nowhere, literally, we ended up having at the last moment to change it to Freddie Mac. And it was like a last little minute change and we were able to get it through. But little things like that are constantly changing, and you have to have somebody who's able to represent and understand the nuances of each of these underwriters. Am I right on that?
I totally agree. And so if I'm looking across the board at the alphabet soup that we just described, I'll get about 20 pages of changes per week, because it's not only just the changes per each individual type of loan, but it's also changes with each bank across the country, because they also will have different overlays or caveats like what you described. So it's important that somebody's on top of those things and is up to date. Most lenders will take a loan, be an order taker, and they will ship it off to some kind of central processing unit where they'll decipher all those different caveats instead of studying up on those things themselves.
So Dan, that leads me into the next question that I have is, if we're dealing with the different underwriters, the alphabet soup, as we've coined it in this podcast, how then do I choose what type of loan to choose? For example, I know there's 30-year fixed, and I know there's interest onlys, and I know there's variables, and there's balloons. And man, how do I choose which one of those fit my particular circumstance?
That is a great question. And my first answer for any of your clients would be, have you discussed it with Justin? Because obviously you guys will have a financial plan in place that you've discussed, and I want to make sure we're all acting in concert. And it kind of goes back to your philosophy earlier and mine as well, which is why not finance more and have more cash availability to put into your investment? So I typically look at a longer term, such as a 30-year. If somebody is just absolutely determined to pay the least amount of interest possible, they might start looking at a 15-year, which will run them about 60% less in interest. The number one question people need to ask is, how long do I want to be in this house? Is it temporary because it might be job related, or, is this a long-term move? And that will dictate a lot of how you're going to shape that loan. Because if you're doing interest only, and I've personally done interest only, my first house in Knoxville was interest only. I did that for 2 years because I knew I wasn't going to be there that long. And we were in a market very similar to now where values were increasing. So I paid nothing on my principal for 2 years, and we still cleared $60,000 when we sold the house.
Wow.
So that was a temporary situation. If you're going to be there longer term, you might want to go lock it into more of a 30-year fixed avenue. That way, there's not going to be variation over time, because all those interest onlys are usually tied to prime or tied to another index, and they will change over time.
So whenever we're choosing the type of mortgage, being the 30, the 15, the variable interest only, whatever it could be, one thing that I often run up against in planning is this thing called PMI. How do I avoid PMI if I'm trying to buy a house, Dan?
There are a few ways to avoid it. So number one, obviously, if you put 20% down, there is no PMI. That's a standard rule across the board, unless you're doing something with the government like FHA. They'll have permanent PMI. You'll never get rid of it unless you sell your house or refinance. But on a typical conventional loan, 20% down gets rid of PMI. If you go over 20%, that doesn't necessarily mean you have to have PMI. You can have monthly PMI. You can have lender pay PMI, which means you don't pay it, the lender pays it on your behalf. Or you can have a variation of the two, or you can finance your PMI, meaning you don't have a monthly payment, but you finance it into your loan. Instead of, say, $50 a month, you might finance an extra $2,000 in your loan and have no PMI. And the decision on that, again, boils down to how long do you plan on staying in that house? Well, if you're planning on staying at really long term, you should want the monthly PMI, because ultimately that will fall off and you'll get the best possible rate. If you're going to finance the PMI, I would say you need to be there for probably 5 to 7 years. It's going to give you a little bit lower payment, but you have that extra expense that's rolled into your loan, and you might have a slightly higher rate. Now, if you want the lender paid PMI where you have no PMI and yet you're over 80%, say all the way up to 97%, that will come at a higher rate, which if you're going to be there long term, then you're going to lose in that situation. But that is the best solution for short term, because that amount of money that you're saving by not having to pay that PMI is never going to equal what that rate difference is that you're going to pay as far as your monthly mortgage payment every month.
Well, I guess we probably should back up and even explain what PMI is, because you and I are talking industry terms, but give me a quick definition, Dan, of what PMI is. What does it mean and what is it?
PMI is the acronym, just stands for private mortgage insurance. And all that means is that if you default on the loan, that insurance will pay off a portion of your loan so that the bank can get rid of that property a lot sooner than they otherwise would be. So that's why you see some of these foreclosures, and in the past you might see a pretty big discount based on the fact that it's foreclosure, because they had that PMI that paid off a portion of the loan. So now the bank can get rid of that property much quicker at a more desirable price to entice buyers to come in and pick up those pieces for them.
So let's you and I walk through a scenario, okay, and help me understand and help the listeners understand what we're talking about. Let's say I find a house, and for simplicity of our conversation, let's assume that I'm going to put 20% down. So my realtor's out. I've already talked to my mortgage broker. He's got me approved temporarily approved with a, what do you call it? A
pre-approval letter. Well, technically the correct term is pre-qualification letter, unless you've gone through underwriting. So pre-qualification letter.
So a pre-qualification letter saying that I can afford a $200,000 house, for example, and I have $40,000 to put down, and we make an offer and it's accepted, and we get through all the contingencies, making sure, that it's not falling apart, it's not rotten, and all the different things that we look for in our due diligence. And now it's in your world. What is it that I need to provide to you as a standard to help get this thing closed?
The standard, if you just think of two, and two of everything, meaning last 2 years tax returns with last 2 years W-2s, last 2 months bank statements, and then typically it's going to be your last 2 paychecks with the breakdown on it, because most people get paid twice a month. So basically 1 full month of pay stubs. And then as far as investment accounts, they're just going to want the last investment account statement that you have. That will cover 95% of everything you're going to need. And that includes whether you're a self-employed individual. If you're self-employed and you do have more than 20% ownership of any business, they're going to want the last 2 years tax returns on the business tax returns as well. They'll dictate that through the K-1 and make sure that the percentage of ownership there, if it's not a sole proprietorship. So 2 of everything. And that, if you just start getting those things ready in the background, knowing that you're coming up on a mortgage purchase or a house purchase, getting those things ready for your mortgage, that will take care of almost everything you need. And some of those things that I might need, or that another mortgage banker might need, might be specific to your situation, but that's going to take care of almost everything.
And then once we give you that, and then we have the terms of the house before closing, you're going to actually put together a closing disclosure, I believe, that's going to give me the details of the mortgage, outlining it. What are the key items that me, the consumer, me, the buyer on the house, what should I look for on that closing disclosure document?
Absolutely. So the nice thing about closing disclosures now, as opposed to in the past, is certain changes in regulation made sure that now lenders are held accountable to the fees that they're quoting to the client. So things that can't change are lender fees. They can go down, but they can never go up. So once a lender's quoted their fees on a loan estimate, they cannot change those fees. So those things cannot change. Things that could change involve estimates for title fees. If you decided to use your own title company, which most people do, along with homeowners insurance, because you get to select those types of things. The estimates are given on both items, but ultimately it comes down to the decision of the buyer. Outside of that, important, you want to make sure that you've gone through the items that were agreed to in the contract and make sure that those are reflected on the closing disclosure, such as if the seller agreed to pay $5,000 in closing costs, for example. So you want to make sure that those show. You also want to make sure that the lender gave you proper credit for your earnest money. And the nice thing is that the lender is required to give you a rough draft copy of your closing disclosure at least 3 business days prior to closing. And that ensures that everybody gets their eyes on it. And it's not saying that they're required to sign it. It's not saying that they necessarily agree with everything, but it's saying that the lender sent them a rough draft. Now everybody gets a chance to look at it, review it, and then make any changes that are necessary. So at that point, the buyer might say, whoa, I wrote an extra $1,000 check to the seller after the inspection. I need to credit it for that or whatnot, or the seller owes me proration of taxes. So it's really incumbent on the lender also to go through that contract and make sure they're doing their due diligence and make sure that they're reflecting everything. So I'm looking at it. I'm giving the buyers opportunity to look at it, and I'm telling them my thoughts on it. Everything looks good. The only thing I see here is maybe they need to add proration of taxes. Here's what that means to you. So those are the types of things that I look at. And then they're also going to get a copy of their final closing disclosure at least a day prior to closing. That way they have a full view of everything that they're looking at prior to stepping into that closing so that there are no surprises.
You are listening to Financially Simple, destroying the complexities of money for today's small business owner.
So, I've looked at a lot of these closing disclosures. You and I have looked through them in detail, even whenever I have other clients who are using different loan officers, et cetera. You and I have looked through different things. And one of the things that always confuses me, my industry that I'm in, at least the way we operate our company, is full disclosure. Everything that we make, every fee that we have is out there. You can see it. I mean, not only do you see it like initially when you sign the papers, you see it like every quarter or every month in some cases, what the fees are. But man, I got to tell you, many times I don't understand how loan officers or mortgage bankers are paid. How are you guys compensated?
Sure. So loan officers, all loan originators, they're either going to get paid one of two ways. They're going to get paid either by the client or they're going to get paid by the investor, meaning the bank that they work for, but they cannot be paid by both. So what the originator gets paid no longer depends on the buyer's negotiating skills. So in the past, if a lender wanted to negotiate with a buyer, either negotiate for a higher rate, negotiate for higher fees, or conversely negotiate for lower fees, but most of the time it worked in the direction that wasn't as favorable for the buyer, let's say. So now all that is out the door. You have to get paid. All loan originators will get paid the exact same on every single deal that they do, and it just depends on how they get paid. So they either, let's just say one bank will charge 1% on everything that they do, 1% origination fee. I don't charge any origination fee. I don't have discount points or origination points. So I get paid the exact same figure that I do on every single deal. So it's really a numbers game, but I get paid through the bank on servicing. We have really low overhead, and that's what it really boils down to is what kind of overhead do lenders have? And that dictates how much they have to charge, but they cannot vary what they charge. They have to charge the same thing to every client. So my dad walks in and wants a loan. I have to charge him the same thing that I would charge somebody I've never met.
Right.
And that takes out any of the gray zone. And I think it's a benefit to the client. That way they don't have stuck with a higher rate just because of their negotiating skills.
Is that across the board that the rate is locked? I know you and I have talked about points and different things like that. Are you operating differently, or is that a standardized now in the industry after some changes?
How we get paid is standardized throughout the industry. As far as what somebody charges, I mean, that can vary bank to bank to bank to bank. But as far as how an individual gets paid, let's say they either get paid a percentage of each and every deal they do. So it's either a percentage, maybe it's 0.6 of 1% on the loan amount, or they get paid a specific dollar figure. Maybe it's $500 for a particular loan. So it's either one or the other. So that's how they get paid. But you can always ask a lender, if I'm asking you to pay a point to get a lower rate, what does that look like for me? I have to give the actual reciprocation of that and say, okay, for a point, this is exactly what that does. It can't be a point might really get you 0.25%, but I'm only going to give you an eighth because I'm going to pocket that other quarter. That goes back to negotiating skills in the past, which is all off the table now.
What does it mean, Dan? You're using the term to pay a point. What does that mean?
A point is just 1%. So think of every point, each individual 1 point equals 1% of your loan amount. So $100,000 deals, that's $1,000. If I give you an extra $1,000, how much lower could I get my rate? Or going back to what we talked about earlier, and this also depends on how long you're going to be in the house. If somebody tells me they're going to be in the house for, let's say, 2 years, they should want me to pay points on their behalf. So instead of maybe the rate 4.5, but at 4.75, I can give you 2 points towards the closing costs on your loan. And so while that difference in your payment might be $30, that's not going to equal the amount of money that I'm going to be able to give you towards your closing costs over those next 2 years. So points can work both ways. It can work to your benefit as far as paying costs, or you can actually drive down your rate artificially lower than what the market might otherwise provide.
So with everything that we've talked about thus far, here's a question, and I'm going to try not to use names here on this, but there's a tendency right now in the marketplace to move toward automation. You move toward online service providers for various services. You deal with it in your business. I deal with it in my business. I was talking with a CPA the other day, and he's like, Justin, this online providers are cutting costs. And I think that's not just in the professional services dealing with finances. We're dealing with it. I've got a client who does auto manufacturing, and he's having to deal with online providers. Everything we've just talked through would lead me then to the assumption that, man, this is so complicated that I'm not sure that I can use a online provider and get what specifically fits my needs at the best price with the best service. Is that a fair assumption?
I would say that's a very fair assumption. So given automated, if somebody is not there to ask you the right questions, it's tough to get the right loan for what you want. If somebody's dead set and everything is strictly vanilla, and by that I mean you're a W-2 employee, you've been working at the same place for over 2 years, you've been in the same career field forever, you're putting 20% down, everything is just straight-laced vanilla, then you might be able to get away with something automated like that. And that's after if you know exactly what you need, right. Which most people don't know what they need given what they want. But now I would say, especially given the caveats that we discussed earlier and all the changes that are constant, especially if you're doing something automated, you're probably talking to somebody that's either in Texas, California, India, maybe somebody with a script that's going to spit back a response for anything you say. So I don't think they're going to give you true knowledge on what you're trying to do.
Yeah, and obviously, folks, I know that is biased and self-promoting, but my point behind that is this, and obviously Dan he doesn't know the questions I'm asking him here, but Dan, it wasn't to build you up. It's more importantly to show if buying your house is the single largest impact on your finances, which to me, I believe it is, especially for business owners even. But if buying the house is the single largest impact on your finances, dude, I'm a CFP. I've got multi-master level credentials, and yet I still have to call you and ask you questions, and I deal with this every day. I can't imagine somebody who's not dealing in the finance world trying to make these type of major impacting decisions without having somebody who's a consultant who's not, as you said, reading a script. It just, and I know there's not a question to my little diatribe here, but it just doesn't make sense to me. So that's the whole reason.
I appreciate that. And if, and that works both directions. And you and I have had conversations on where I'm going is from a 30,000 foot view of where we're going financially and what you're trying to do for me versus what I'm looking at maybe on a house that I wanted to buy and how I wanted to finance it, what that means to me as far as cash flow monthly. I would recommend, and I wish everybody had a good CFP that could advise them on those things. And I do recommend, and especially when it's one of your clients, have you talked to Justin? And then I always, want to ask permission to discuss it with you on what I'm looking at, what I see for what they're asking me, and then make sure that coincides with what you guys are trying to do on a financial planning basis.
So let me ask you one more question here. We're getting close on time. And let me ask this question. And I ask everybody that I interview this question. It's one that I was asked years ago, and it gave me pause. And the question is, what is the one question you wish that customers would ask? And so let me lay it while you're thinking about this. And people who listen to podcasts, you've heard me say this before. Many times people will come into the office here and they'll say, hey, Justin, I need help with something, a financial planning issue, asset management, a business growth issue, whatever it is. And they'll ask me about cost, which of course, it's a fair question. I think we all have to deal with that. They'll ask me about a number of things. They'll ask me about how we're going to accomplish it, et cetera. But they never ask me the why. Why is this important to you to be doing this with me? So that's the one question I wish people would ask me. I'm sure that in your business of 20 some odd years now in the mortgage business, you have that one question that you're like, man, Justin, I wish folks, when they would come talk to me, would just ask me this one thing. To me, it's the ethos, it's the core value of what I have. What would that question be?
I would think as far as from a knowledge basis, maybe explain to me why, I should go with you, or maybe the process of how you guys do things differently, because we are different. And the team that we've had, I've had the exact same team, whether it's coordinator, whether it's processing and underwriting, all those types of things for about 12 years now. So I know almost in any given situation how they're going to react, what the time frame is going to be, and then how we pick up the pieces if something turns up that, wasn't anticipated. And then secondly, I would say most of that a lot of times people will call, what's your rate? They'll call it, which kind of like what you said, how much does this cost? It's a fair question. Yep. But if you don't know the fees and you haven't looked at the fees and you don't look at the rate and fees together in a specific time frame, you can never compare apples to apples, because the mortgage market, the mortgage bond market, which dictates rates, is moving in time with the stock market. I mean, it's constantly changing, constantly. So rates constantly change. So if you do not get rates and everything on the same day, along with the fees, then you're not going to be able to get a good answer. And I would also feel out the lender, because not everybody's a good match. Communication. How are you going to communicate with me? And because I think, and judging from the first 5 years of the business, I always wanted to know, what did people see? What were their experiences? What did they like? What did they not like? And communication was always the number one thing that people were frustrated with. The lender will not call them back. The realtors are frustrated with it. The lender won't let them know where they are in the deal and that sort of thing. So we are a high communicating team. And so I give people probably more communication than necessarily they need, but I'd rather everybody know where they stand. And typically, we're done in 3 weeks. So I hope that answers your question.
Yeah, no, it does. It does. So let me ask you this. I know there's thousands of people. You'll be surprised how many people listen to this podcast now that are going to hear this. And they're going to be like, dude, I have some questions. Dan, how can people reach out to you if they have a question? Obviously, you and I have talked about this. The whole goal is not to try to do this so we can sell folks. That's not the goal, is to educate people. But nonetheless, people may have some follow-up questions, to cover what you do or what any professional does, or anybody does for that matter, in 25 minutes is just about impossible. But if someone has a question, how can they reach out to you?
Yeah, absolutely. The quickest route would be my direct line, which is 865-963-0409, or they can also go to our website, which is eliteservicemortgage.com, all spelled out, ELIT servicemortgage.com. And on there's an apply button if someone doesn't have time to discuss things over the phone. And once they fill that out, it's a secure link that'll come directly to me. All else fails, you can always email me, and it's just dan@eliteservicemortgage.com.
So with that, Dan, thank you so much for coming on the show today, man. Any last parting quests before we sign off on this thing?
No, I would just say ask open-ended questions to your lender, and the lender should be doing the same. If your lender is not asking you any questions, that means they're just an order taker, and I would question them how much they really know about what they do.
So what we're going to do, folks, as always, is we're going to put the show notes and links for today's podcast at financiallysimple.com under the heading podcast. And while you're on the blog, feel free to check out and sign up for our weekly newsletter. Every week, I release tax tips, business planning tips, wealth management tips, and so much more. In fact, I just earned a new designation, and we're going to start adding some things on how to grow the company. If you're, many of our listeners are small business owners, and we're going to start focusing on methods and applications on how to grow your business. If you like the show, please subscribe, and hey, share the podcast with other business owners. Like I say every week, life is hard, life is good, and life can be frustrating. Money doesn't have to be. Let's continue to make our lives at least financially simple. Hey, Dan, thanks for coming on the show, and everybody else, make it a great day.
Thanks, Justin. I really appreciate it.
You have been listening to the Financially Simple podcast. The information in this show is for informational purposes only. This show is not investment advice. Instead, seek help from a competent financial advisor. Justin Goodbread, CFP, is an investment advisor representative of Heritage Investors, a registered investment advisor.